welcome everybody officially to what we're calling our smarter exit strategies for highly appreciated stocks, which is the 351 exchange. This evening, I'll be your host. I'll just kind of walk through things together, but who you're going to be hearing from the most is Nic Gookin, our Chief Investment Officer. Of course, we have Ryan Mannon, our COO, on here just in case we have any tech issues or to, just pull in any questions. Sean, unfortunately, is not able to join us tonight. I think his middle one has a soccer tournament, so he's out for that. But, as always, if you have any questions, you can feel free to reach out. But we're really excited to go through this here this evening. We're really just going to talk about what a 351 exchange is. As Nic alluded to, it is a relatively new, it is not new and I'll let Nic get into this, is not new in the tax code, but it's just gotten more popular here as it's become kind of an ETF version of this. And so we will talk about appreciated stocks and, feeling quote unquote locked up in your portfolio, some exit strategies, what the 351 is, how it qualifies, use cases. And then Nic has a little special mystery bonus strategy in here that I'm excited to learn about because honestly, I didn't even know that was going to be there. So as always, if and when you have questions, please feel free, just drop them in the questions area. We will do our best to answer them either when it makes sense or right on the spot. This will be recorded, so hopefully we watch it many more times to come. So Nic, without any further ado, please go ahead and get us started and take us through.
All righty. Yeah, I had to throw the bonus one in the end, for all of the troopers who hang with us through 351 information webinar. So throw a bone over there. So the real genesis of this presentation, or why we are even talking about it in the first place, is just because we have a lot of clients that come to us with highly appreciated, or another way to say it is low basis stock. And that means that congratulations, you were a successful investor and you bought something at a lower price and now it's at a high price. And even though that's great and all on the surface, that can present risks by itself. Like if that position gets to be too big of a slice of your overall pie, and then you have to ask yourself, what are the different ways to manage that? And so one of the things that we talk about often is tax loss harvesting. And I know I've probably bored you all to death over a few tax loss harvesting conversations in the past, but even the best tax loss harvesting strategies can still lead to what we call like locked up portfolios, or where every single position is adding gain. And so again, these are good problems to have. But then the question is just, once we're in that spot, what is the next moves that we can make and do that with as little friction as possible? So that's really, why we're having this conversation. 351 plays a good role in that. So actually, there's a great leader in our industry, Brett Sullivan. He has a whole entire channel dedicated to different tax strategies for advisors, clients, etc. He's former head of Morningstar, so very smart guy. But anyway, he uses this analogy of like bananas and banana bread. Like once you hold on to a stock for too long, it can skip right past the banana bread phase and go straight into the compost phase. And so the reason that we start to get concerned with those appreciated stocks is that, it's nice to look on your statement and see the, 1,000% return or whatever it is on there. But what happens and what the data shows us is that the longer you hold it, the more likely that stock is to have huge, major 50+% drawdowns. And especially over, 10, 20, 30 years, it's like almost all the stocks experience that kind of volatility. And, that's normal, we would say, for any given stock. But when that becomes a huge piece of your overall pie, that's when it starts to get a little more stressful. So our goal is to help everyone mitigate the compost pile as much as possible and try to optimized for the banana bread phase is our mission here. So
And Nick, did you do this for me? Like banana bread, banana pudding is literally my favorite dessert. So, this is perfect. And so thank you for doing this just for me.
yes, but any sort of food analogy I knew would just resonate really well with Bob. So
Yeah, thanks.
that works out. Another like reason why it makes sense to look at diversifying those big winners is because this chart does a really good job showing how last decade's winners usually don't translate into being like the biggest stocks of the next decade and the next decade. So if we look at like 1985, the biggest stock in there was IBM. And then by 1995, just 10 years later, you can visually see it's a much smaller piece. But then all of these other stocks that are green are from the 1985 vintage of being the biggest and baddest. They were replaced by new stocks from the 90s. And then more were replaced again in '05 and more replaced in 2015. And then 2025 looks even dramatically different another 10 years later. So even if you had those, like Exxon, and it was the biggest stock, we've seen it time and time again where they usually don't hang out in the top ranks for multi decades. So anyway, just another interesting chart to say last decade's winners might not be next decade's. All right. So exit strategies. Number one, we could always just sell and pay the taxes, right? That's one of the more simple approaches. And we honestly like to have that conversation with clients too. It's like we can do all kinds of fancy things. We usually don't go too fancy where there's not enough, as Bob calls it, return on hassle or return on headache. So we want to make sure that what we're doing, like if we're going to do something fancy, we really want to make sure that the juice is worth the squeeze. But oftentimes it's not, right? Just paying the taxes and moving on. But sometimes even that's a tricky conversation to have because sometimes you might be in a distribution phase and it's like, okay, now we're selling these big stocks or these highly appreciated things just to get money out. Other times it's, hey, my portfolio is 100% in equities and I want to just de-risk. So it's like 60% in equities. Like what are some ways to go about that? And so that's a little bit tougher where like you're looking at paying taxes and, not taking money out or seeing an immediate like tangible benefit in your hands. So those types of conversations definitely play a role in this. Other exit strategies, you could always add cash to the portfolio anytime that you're making, and these are all very backable, but these are all like taxable accounts that I'm talking about here. So like IRAs, 401ks, Roth IRAs, those are completely different animal. Everything on tonight's webinar is talking about taxable accounts. And when you have stock in like a brokerage account, a joint account, trust account, that kind of thing. So when you add cash to an account like that, it creates a bunch of new tax lots when we go and buy stuff. So if we bought stuff 20 years ago, let's just say Coca-Cola, and then you put more money in today, it's like, well, now if we buy more Coca-Cola, let's say the price was here and now it's here, then it gives us more opportunity for tax loss harvesting and some more maneuvering there. So that's always great, but not a lot of people can just solve the problems in their lives by just adding more money, right? Or adding more cash to the equation. The other one is charitable giving. I know Bob did a really great job. Was it last month, Bob? The month before, something like that?
I think it was last month on the donor advised funds. Yep.
Okay, yeah. So we already touched on how that can help move the needle on a lot of these highly appreciated stocks. And this is, I will say, like that can be used in tandem with what we're talking about tonight. Like it's not always an either or.
And I would think any of these strategies in tandem with number 5, what you're talking about tonight. Yep.
Yes, absolutely. So, yeah, good point. All of these can work together. It's usually not just one, as we see with our clients. Long short strategies, whether we accomplish that by like actually going short stocks or using like more fancy options based strategies. We do have a number of folks in that as well, but 351 exchange is kind of one of the last pieces here that help you exit those highly appreciated stocks. So I know that was a lot. But that's I wanted to cover the bases on just like how this fits into the overall dynamic here, what we do. So,
Yep. That was really good, Nick, too. And just to clarify again, as Nick alluded to, this is specifically for appreciated securities within non-qualified accounts or brokerage accounts. So an individual account, a trust account, a joint account with your spouse, right? Anything inside of an IRA that is uh, not what we're discussing today because we can diversify that with no tax issue whatsoever. So just to be clear that, but this is a good start here, Nick.
yep, perfect. So, what is this 351 exchange that we're talking about here? It's like, well, 351 exchange refers to a section of the tax code, section 351, which allows individuals to contribute property such as stocks or ETFs to a newly formed corporation. Now, newly formed is a key word there that I want to make sure that we don't speed past. Um, but there are some specific tests that the good old IRS wants to make sure that you hit. So we'll talk about those. But in general, we said, is it new? It's like, is it new to our industry? I'd say yes, probably in the last I'd say in the last 5 years, it's become more accessible to advisors and just more of our everyday clients. I think there's probably corners of Wall Street that have been doing this for very, very long time. But it was actually written into the tax code all the way back in 1954. So this is not new in terms of like, was it part of the most recent tax bill? I know there's been so many changes to the tax code lately. This is not one of those new changes. We're just finding that the investment firms are figuring out a way to use this section in kind of newer, more innovative ways. So, okay. All right. So what are these qualifications? This might sound a little crazy to people, but number one, you have to be a US person, not a corporation. And then number two, contribute a diversified, in quotes, portfolio. And diversified by the definition of the IRS, which of course, I don't know if they consulted a financial advisor for this, but this certainly is kind of a crazy definition of diversified. So first of all, the eligibility as far as like the types of different accounts, so individual joint accounts, these are the types of accounts where those appreciated stocks are held that you're allowed to do this type of exchange generally. And also, disclaimer, we are not tax attorneys or CPAs. So I would certainly want to make sure that everyone listening consults with their tax professionals. But this is a really good informational starting point on how to go about this. And we are happy to walk that walk with you and make sure that we have all of our bases covered. So, but anyway, individual accounts, joint accounts, most trust accounts are fine. LLCs, corporations, no fine. So that seems pretty easy. Now the asset eligibility is the other piece. So this only applies to stocks and ETFs specifically, or exchange traded funds. Mutual funds do not qualify. Unfortunately, that would be amazing. Cryptocurrency does not qualify. Derivatives, options, and even cash doesn't qualify. So we are just looking at stocks and ETFs. And then as far as the minimums go, Schwab has a $150,000 minimum, and I think Altruist is it's either the same or slightly lower. So right in that ballpark, though, as far as how much you need to contribute to do this. And all right, so the whole diversified portfolio thing. Rule number one is no more than 25% of what you contribute to the 351 can be in a single asset. So 25% of the pie can't be in more than one stock can't be bigger than 25% of the overall pie that you push in. And then the other rule for diversification is no more than 50% of the portfolio's value can be concentrated in 5 securities or fewer. So practically, this means the IRS is looking for usually around 10 securities or 11 securities or more. But silver lining in this that is also worth noting is the IRS does use a look-through provision for ETFs. And so what that means is if you have, let's just say, 25% in a single stock and then 25 or even 75% in an ETF, you probably still qualify because within that ETF, the IRS looks at the weighting of the individual stocks at the time that we're doing all this. So um, that's good news for net of all that is good news for you because usually ETFs can be used to help solve a lot of these lockup situations. Even just layering them in strategically can help not only diversify the account before the exchange, but also can help qualify it coming into the exchange. So pretty cool there. And I'll go through more examples of what this looks like. So that way we have a better understanding. I know I'm throwing a lot at you all, so thanks for hanging with me. But okay, so example number one, the $1 million diversified portfolio across 25 stocks. So that totally easy peasy can do a 351 exchange, even if 25% of the portfolio is in like Tesla, for example, in this case. You could swap that entire portfolio out for a new ETF. And I say new ETFs because, again, the 351 exchange provision only works for newly formed corporations. So this is not moving into like an existing ETF. And therefore, the timelines of all this stuff gets really important too, because we have to pull the trigger on this right at the same time that the ETF is launching. And otherwise, then there's no 351. Then we're just selling stocks and going back into that equation. So to convert, it has to be right when the ETF launches. Now, another example is what if we have a diversified portfolio, but it's got 15 different ETFs in it? Yeah, we can actually clean up a bunch of different ETFs. So sometimes folks transfer in funds from other institutions or wherever, and this mechanism can help us just simplify and consolidate portfolio holdings, which can be really nice. Like let's say all of these, it's possible, I've seen it actually many times where someone will have 15 different US large cap ETFs, and we could actually just squish them all together in through this 351 conversion. And then you have one line item instead of 15, which just, helps with our overall mission of simplicity and keeping things easier for our clients to keep track of. And so that
So Nick,
totally possible there.
Nick, just a quick question for me on this one here. So in this scenario here, if you have a basket of ETFs, you do have a diversified portfolio already generally, but they could be sector ETFs, they could be all kinds of different things, right? And so this new ETF that they're moving to, what type, like, is it going to be just like a large cap? Will it have mixes of domestic, international, mid cap, small cap? Like, what generally is the result of doing something like this, whether it's the stocks or the ETFs?
Yeah, no, it's a fantastic question. So, answer is it depends. There's different ETFs that launch throughout the year, and some of them are just US large cap. They're just S&P 500 index funds. Some of them are more like global, where it's, partially US, partially international. Some are that small mid cap sector or exposure. So yeah, the ETF providers are trying to use this 351 provision to help people consolidate, clean up, and then make sure that whatever portfolio they land in is like actually what they want to be invested in long term. So it's a very important question that you asked. And yeah, certainly something that we look at for folks. Like I think the next one launching is in a month or two, and it's just a US large cap S&P 500 fund. So that's the one we'll hang out with for most of the conversation tonight. But yeah, there are other ones certainly.
Okay.
All right. Yeah, and then where this gets really helpful is when it's not just 15 line items, but what if it's like, extreme example here, 800 stocks and 10 ETFs? Like, cool, pile them in, let's clean this puppy up. And, we'll really, really start to simplify things here. 1099 will look a lot simpler too, having far less line items there. So, and just less dividends to track. Like every single thing you own usually has dividends that come out monthly or quarterly. And so it gets to be a lot of line items, just transactions and everything. So there's something to be said about just landing it in a simple, unified strategy, like a low cost ETF. All right. So now the examples that most of our clients have, I would say, faced or where we're looking at using 351s probably the most, that will probably move the needle the most for them. And this is that scenario where it's like, let's say they have a $2 million portfolio and they have $1 million in like US large cap ETF or ETFs. And then they also have like half the portfolio in a single stock. We'll just say Apple for this example. For the 351 purposes, we can't do the full enchilada, the full 2 million, because Apple would be half the portfolio value, right? And we're limited by that 25% in any single security. But we also have to consider that there's Apple exposure in those US large cap ETFs that we own too. And so this example, Apple makes up 7.6% of the US large cap ETF. So therefore, we can't do the full 250,000 out of Apple, but we can still do a total of 225,000 out of the Apple stock. And then you can see just visually the gray line for Apple got smaller and your overall exposure to the diversified like US market got bigger, and there was no taxes involved to do that. So pretty cool. I'm going to pause there. Any questions or anything on that?
No, not at the moment. You're doing great, Nick.
All right, keep it rolling. So since you've hung on this long, you have now made it to the mystery bonus.
Wait, hold on. Sorry. We did have a question come through just on the, looks like on just the ETF itself. So, what, like, when it comes to, because fees, right? So basically the question is, what are the fees associated with this at this point?
Yeah, it's a great question, especially when you're going from like individual stocks where there's no like expense ratio or anything. The fees for the next ETF that launches that we're looking at is like 9 basis points. That's 0.0945% or something like that. So it's very, very, very low. And that is far. The expense ratio, just back up a little bit, is the annual cost of running the ETF that just gets pulled out from the ETF itself. It's like kind of the embedded cost there. But as far as like transaction fees, there are none. So there's no, like we don't charge commissions. Thankfully, the fund companies that do this also do not charge commissions. So they're really just looking to get that 9 basis points into perpetuity or however long you hold this. And so, yeah, super, super low cost option. And a lot of tax strategies that we look at are usually not very low cost. And so,
Yeah.
This one is very interesting for that reason.
Yeah. Perfect. We have another question here, Nick, that is, how are the individual stocks, different cost bases treated in the new ETF?
Oh, great question. So I'm going to skip past I'm going to just put that one in at the end because I have a whole slide dedicated to it after my bonus question. So I'm going to table that one for a minute.
Okay. That'll get answered here shortly.
Yep. Can't steal my thunder. All right. It's too good of a question. All right. So the bonus strategy though is, what if we just run it again? And so, here we are with 775 in Apple, but then the next time there's a 351 exchange. Now we're starting with a more diversified portfolio to begin with, right? We have more in the US large cap, less in the single stock. So therefore, more of the Apple qualifies. And there's actually nothing stopping you from doing it again either. So you could
Mm,
have all of it move to a diversified portfolio. Now, there's a lot of assumptions that I used in this illustration. Like A, that Apple wasn't changing value and your portfolio wasn't changing value or anything. But overall, like this particular thing does pick up some IRS scrutiny if you do multiple 351 conversions super close together. And so the best advice that I've seen on this is to spread them out over multiple years. So that way
mm,
the IRS doesn't look at them with their step transaction doctrine, where they can retroactively say, no, this was equivalent to you selling the stock and buying the ETF, and they can just force taxes that way. So we don't want that to happen, and that's why it's very important to make sure that we, are dotting our I's and crossing our T's on all of this stuff, but also not trying to do too much all at once where it starts to pull up all these red flags. But normal 351, like doing it once, like zero problems with that. Doing it twice in a couple years, like it's usually fine. It's more like if you try to do 3 or 4 conversions in under the course like a year, then IRS doesn't generally like that.
okay.
So
And we had a question from the audience here, 1 step per year or a little less? It sounds like a little less, like maybe 1 step per, I don't know, year, 1 to 2 years, something like that. Nick, is that
yeah,
ballpark? Or
I think
and
like
maybe we
aiming
don't even want to
for
define it. Like,
yeah. It's one of those things where it's just very loosely like there's not an explicit rule where it says you cannot do more than. So it's open to interpretation. That question is like, what's your appetite for IRS risk or audit risk? And so usually I would assume
low,
pretty
Nick, or
low,
the answer there is
exactly
low. You know.
low. And so um therefore, like I would say probably wouldn't want to do more than like one a year just to be super conservative. And then of course, like, this might be what it looks like after year one, but just from market movements, we've seen this before too, where, we do all this work, we reduce the concentrated stock, and then the concentrated stock just has like a blockbuster year, its best year ever. But all of a sudden the stock is a bigger weighting in the portfolio than what we even started with. And so chances are like, it wouldn't work out perfectly like this over 3 exact conversions anyway, just because the way that the securities bounce around so much. But yeah, so I'd say I aim for maybe once a year to be conservative there. Okay. So bonus strategy, just run it again, run it up the middle. All right. So questions. I am so glad that somebody asked that question because I was prepared for it. And what about my tax loss? So when you start with the portfolio on the left, so let's say you have all these different holdings, or maybe it's all the same holding, like ETFC with tax lots from 2020. Um, all of those tax lots come over in kind into the new ETF. So they don't just get lumped together and averaged. They actually come over line item by line item into the new ETF, which is actually super good for you
Mhm.
because it allows us to still do all of the other planning strategies that we have, such as the donor advised fund and the giving. Like we can still gift the tax lot with the 1,000 or 2,000% return to get you the most bang for your buck on that. Um, and so there's a lot of benefits to this very granular structure versus it all getting averaged together. So it's just this way it works. So
Got it. That is really helpful, Nick. I was curious about that myself, and seeing this, just to reiterate your point, how important and beneficial it is to maintain the separation of the tax lots. Because as you know, like that helps us in what do we sell sometimes, what do we donate, what do we, move to the next 351 exchange or anything in between. So the fact that it doesn't just get kind of smushed together and just averaged out is actually really beneficial to the end kind of I don't know, users is the right word, but to our
Yep.
clients.
Yep. Yep. Absolutely.
Cool.
So, all right. Well, any more questions there?
All right. Let's see. Um, so even a very small tax lot from a dividend in an individual stock will come over by itself.
Yeah, so I think there is like a little bit of, I think they drew the line at like fractional shares. So like they'll make you round them up to whatever. So like let's say the dividend created 2.1 shares or something, like they'll take the two and then just leave the point one and then we can
Mm.
deal with that. So whole shares, which I think is fair, this can be a lot, is the way they roll with it. So
Got it. Right on. Great. Yeah, those were some really good questions. Nick, just going through this, it's really helpful. And again, just to go back, and you don't have to flip back through the screen. Yeah, let's put the disclosures up as I just say something really quick, just so we check the compliance box. But the thing that I want to reiterate that you brought up towards the beginning is this is just one of many different ways that we can diversify out of highly appreciated securities, right? Like it's a good problem that clients run into. This is a relatively new one. And I know that they're called exchange funds, had been popular for a while. Those are highly illiquid, very different. Like you have to hold in an exchange fund for 5, 7, 10 years, right? That is another option that kind of extends on this. But that's why we hope that through the planning that we do, these conversations we have, that as these things come up, we can help work through which of those 5 options that we laid out or that Nick laid out so well is the best based on your specific situation. So, it's not an all or nothing to 351 or donor advised funds or just selling it and paying the capital gains. The right combination is what's best.
yep, yeah. Those yeah, so those exchange funds, absolutely, Bob. Those are the ones that would have the big commission and
Yeah.
transaction fees
Expensive.
associated with
Yep.
the expensive ongoing holding cost, and then yeah, you get K1s, all that stuff. So
Oh,
yeah,
yeah.
just holding the ETF makes it super easy because then you get daily liquidity, of course, after the fact. So
Yep.
yeah.
And we got one final question here. And, basically, this all sounds great, right? Like, and um, it's is there any reason not to do this or not to do too much into a 351 exchange?
Yeah, I've asked myself that question. I think the main like potential downside is that like you got to make sure that you like or enjoy the new fund that you're going to be parked in, right? And so that's why I think it's really good and important to probably just pick like a low cost index fund for a majority of these versus going into some like multi-factor global allocation strategy or something like more like that. Like just a simple, like more plain vanilla as a landing spot here, I think can be just a really solid thing. And then, yeah, as far as like not doing too much, I'd say you probably want to do as much as you can because even if it doesn't work out, or like let's say we do this conversion and then we don't like the ETF that we land in, it's like, well, when a new ETF launches, we can swap out this one and go onto the other new one in a year from now, whenever we want to do that. So it's not like you're married, committed forever per se. But yeah, just keep that in mind too.
And I think just Nick, just if I can add to that, the other downside that I see is the loss of upside in the concentrated position, right? So, I think there's a saying in financial planning, right, that concentration risk, which is just owning one stock or focused set of stocks, gets you rich. And then diversification keeps you rich, right? Like, and hopefully compliance not tracking that, but that's just a saying, right? But a downside here, you do too much and then Apple doubles again, right? And you took some off the table and the ETF doesn't do as well. But that again comes back to the planning. Like, how much return do you actually need? How much do you need this to continue to grow, to actually accomplish your goals and those things that are important to you? And how much about it is just risk management and being like, hey, enough is enough, a win is a win, and how do we start to diversify this? So that's, I think, the toughest question to answer. And a lot of times there's like this emotional tie to these highly appreciated kind of winners. But just talking through that with us, with your advisor, can be a great way to figure out what's the right amount, what's the right landing place, and how do we make sure we build this into an overall plan.
Yeah, that's the gambler in you talking about, right?
Yeah, for sure.
Try to tell it longer.
Yeah. So,
No,
well,
we did that other presentation on was it the drivers of performance, right?
yeah,
The investor psychology. In that one, I think this is a huge investor psychology exercise too, like being okay with diversifying out of some of those big winners. And even though the data shows it, right, going back to banana bread and the chart that shows the big winners usually are the top dog for multi-decades. It's still hard, like when you have had
yeah.
that good success here. So I get it. I understand.
Well, 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 hey, Nick, I think you did a great job. We don't have any more questions that came through. So I'm going to go ahead and just wrap it up and close it out here this evening. So everyone, thank you so much for being a part of this evening. Nick, thank you so much for educating us and walking us through this strategy that may be a new one. If you have any questions or want to follow up and see how this might fit into your strategy, just feel free to reach out to any of us. We're here to help. Ryan, thank you for being here and making sure tech went well. So we appreciate you as always. Hope you all have a great night. Hope the Browns hit their draft pick, and we will see you again next month with next month's webinar, which I think is still to be determined. So thank you everybody for being here. Nick, thanks again and have a great evening.
Yeah. Thanks guys. Talk to you soon.